Hello and welcome. Thank you for joining our webinar on investment structures and related tax considerations. This webinar forms part of Mayor Brown's annual pensions conference, which is a series of webinars covering current and upcoming topical matters relevant to the pensions industry. My name is Duncan and I'm a counsel in Mayor Brown's pensions practice, specialising in investments. We're joined by my colleagues, partner Tim Nosworthy from our Fund Formation and Investment Management Group, and partner Simon Rose from our tax practice. Together, we will examine the key features of the most commonly used investment structures, including the tax implications of these structures, and in particular, the implication of a UK pension scheme being deemed to trade. During this series, we'll also address topics including changes in pension scheme investment compliance and disclosure requirements, pensions litigation, GMP equalisation, covenants and funding, effectiveness of trustee boards, and the Pension Schemes Act 2020. Starting at the agenda, you will see that we will break this webinar down into various sections, covering, firstly, the typical investment structures, and I'll describe the key features of each of these in turn. We will then describe the key considerations when selecting an investment structure, and in particular considerations around their liquidity, regulation, and their structural characteristics. And lastly, we will talk about tax considerations, particularly tax neutrality, withholding tax, and UK tax issues, including the consequences of being deemed to trade. So, the typical investment structures that are used by UK pension schemes are pooled funds, which are often called commingled funds, funds of one, and investment management agreements. There is, of course, lots of jargon used with investments, and so you may have heard of funds of one and investment management agreements being referred to as separate accounts, separately managed accounts, or segregated mandates. Tim is going to talk to you about pooled funds and funds of one, and then I will describe investment management agreements.
On this slide, we have shown a very simplified fund structure chart. As you'll see, the triangle in the lower centre is the fund vehicle itself, in this case a limited partnership. This is the vehicle that will make investments and into which investors will invest as limited partners. Above that, on the chart, are also all the entities related to the management of the fund, so its general partner and investment manager or AIFM, as well as the carried interest structuring arrangements, the carried interest being the share of profits paid out to the management team, which in a European fund is typically paid out a separate vehicle, in this case, another limited partnership. An investor in a pooled fund will, in terms of legal documentation, typically be presented with a pack of fund documents. This will usually comprise the core constitutional documents for the fund itself. So, in the case of a limited partnership, its limited partnership agreement, as well as a private placement memorandum, which is essentially a marketing and disclosure document, and the subscription documents, which will usually comprise an agreement to subscribe, as well as what is essentially a KYC questionnaire. In addition, an investor may be offered or may ask for a side letter setting out additional terms agreed on a bilateral basis between the fund manager and the investor, but which are not applicable to all investors. The investor may also, although not necessarily, be provided with copies of the management agreements for the fund, although as the investor is not a party to these directly, there is usually little scope for it to make comments or request changes to these management agreements. If we are advising a potential investor, such as a pension scheme trustee, on its potential investment into a pooled fund, there are a number of key areas that we would focus on, and some of these are set out on the slide here. The key point to note, though, is really the first one, which is that, in general, there is limited, if any, ability to influence the characteristics and terms of the fund. Now, this is, of course, a generalization, and there are circumstances where an investor in a fund, either because of the amount that it is investing or because it is an early or anchor investor, will have significant negotiating leverage. At the other end of the spectrum, an investor making a relatively small commitment to a fund, where the fund may already have had its first closing, will have far more limited scope to negotiate and is essentially investing on a take-it-or-leave-it basis. And in between these two ends of the spectrum, there are scenarios where an investor may well be able to negotiate some changes to the fund documents and also negotiate a side letter with the fund manager. The approach that we would normally take when advising a potential investor is really to review the fund documents provided and prepare what is essentially a red flag report highlighting areas where the fund terms appear unusual or off-market or where they differ from what is expected. That report would then form the basis for deciding whether there are any terms that the investor wishes to negotiate, and if not, would constitute our advice to the investor on the fund terms. The other area where we would typically be involved is in looking at the structure from a tax perspective, and Simon is going to come on and discuss this later on in this presentation. Next, we're going to look at funds of one, which, as we noted earlier, can sometimes also be referred to somewhat confusingly and interchangeably as separate accounts or separately managed accounts. Really, the key thing to note here when looking at the structure chart is that this is pretty much identical to the chart we showed earlier for pooled funds. In fact, the only real difference is that this structure only has a single investor rather than multiple investors, and hence its name. Funds of one are usually set up where an investor wishes to make a fairly large commitment to a particular strategy and wishes to have a more bespoke structure or vehicle. The reason for using a fund of one structure rather than having an investment management agreement, which Duncan will come on to talk about shortly, may be to facilitate a manager co-investment element, a so-called skin in the game piece, or a carried interest structure for the management team. Or it may be because the nature of the underlying investments means that a fund-like vehicle is more suitable for making the investments. It follows from this that the documentation for a fund of one and the legal issues that typically need to be considered are broadly very similar to those for a pooled fund. The key difference is that because a fund of one is essentially a more bespoke product for an investor, the investor will typically have a far greater level of input into designing the investment strategy and influencing the characteristics and terms of the vehicle. For example, if we're advising a potential investor in a fund of one, we would typically expect there to be more extensive negotiations related to the terms of the limited partnership or other constitutional documents to seek to make the terms more balanced as between the manager and the investor. In other words, it's a more negotiated process than simply investing in a pooled fund.
Thanks, Tim. In this diagram, you'll see a classic investment management structure. The investor appoints an investment manager under a contract, then under that contract, the manager will purchase investments on behalf of the investor. Unlike the previous structures Tim has discussed, these do not involve any sort of fund structure. They're direct arrangements between an investor and the manager. In the pensions world, these arrangements can be advisory, where a manager will provide investment advice to the pension trustees, and the trustees will make the investment decisions, although this is a less common model for pension schemes, as many do not have the in-house investment expertise to make an investment decision. Alternatively, they can be discretionary, where a manager will make investment decisions on behalf of the trustees and will implement those decisions in line with an agreed set of investment guidelines. With discretionary, the trustees will normally have received strategic investment advice from their investment consultants in order to set those guidelines. Lastly, they can be fiduciary management. This is similar to discretionary, but fiduciary tends to be in relation to the whole scheme assets, whereas discretionary is normally only over a portion of the scheme's assets. The strategic investment advice will have been provided by the fiduciary manager rather than an investment consultant. These investment management type arrangements provide possibly the most control for a pension scheme to receive a bespoke product, since they enable the trustees to negotiate directly with the manager on key investment points and they are also easily amended during the life of a mandate. This does, however, lead to higher fees and costs in general than investing in a pooled product. With these structures, pension schemes need legal assistance to review and negotiate the relevant documents, particularly in relation to liability for the trustees and the manager, and also the ability to terminate the arrangement if things go wrong or if performance is not what was expected. Tax structuring advice can also be advantageous to ensure that investments are being acquired and held in the most advantageous way. We turn now to considerations when deciding what type of fund your pension scheme should invest in or be permitted to invest in under an IMA. The first of these is liquidity, being how easy it is to sell or redeem the interest. Funds are generally viewed as being either open-ended or closed-ended. With open-ended funds, they are normally far more liquid investments than closed-ended. An open-ended fund's share capital is not fixed. Instead, the number of units in issue expands or contracts as investors subscribe or redeem. It is presupposed that open-ended funds will hold liquid assets with a credible market value. You may have come across open-ended funds in the context of UCITS funds and classic hedge funds. With closed-ended funds, if it is listed, such as investment trusts, then the shares will generally be illiquid. If it is not listed, interest in the closed-ended fund will normally be illiquid due to redemption or transfer restrictions in its constitution, or there will be a limited secondary market for the interest in it, that's being able to sell the interest to another investor. Closed-ended funds are mainly structured as limited partnerships, but can also be bodies corporate such as PLCs.
Duncan has just touched on one key distinction, which is between open-ended and closed-ended funds. I'm now going to cover another key distinction, which is between regulated and unregulated funds, and then go on to make the point that from an investor's perspective, the distinction between the two is perhaps not as significant as it might initially seem. As noted on the slide, regulated funds are, broadly speaking, funds which are subject to extensive regulation in terms of their constitution and investment powers. And as a result of this, they can be marketed more freely to the public. So these are commonly referred to as retail funds. An unregulated fund, by contrast, isn't subject to that same level of regulation in relation to its constitution and investment powers. And the consequence of this is that it cannot be marketed freely to the public, and really only to institutional investors. So these are typically known as institutional funds. So UCITS funds are a classic example of regulated funds, and private equity funds are a classic example of unregulated funds. But the reason that, from an investor's perspective, I think that the distinction between regulated and unregulated funds is not so significant as it might seem, is that even if a fund is unregulated, it's highly likely that the fund manager will be regulated with its own regulatory obligations. And in addition, and certainly if the fund is in the UK or the EEA and falls within the scope of the AIFMD, the Alternative Investment Fund Managers Directive, then the manager will be subject to a whole host of obligations under that directive aimed at investor protection. The issue, though, potentially to watch for is unregulated funds, which are set up in more lightly regulated jurisdictions and or where the fund in question may fall below the threshold for any applicable regulatory regime. The potential red flag here is that in this case, if anything goes wrong, for example, a complete or significant investment loss, which is arguably down to the actions of the manager, the investor may be left with limited options for seeking recourse. I've also put up a bullet point here, impact of Brexit ? I live in hope that one day I'll be able to put this up without the question mark, but alas, that day has not yet come. The impact of Brexit on all of this remains to be seen, but there is a good chance that it will become more difficult for UK regulated firms to carry out regulated activities in the EEA. What this means is that although investors will still very likely have a wide choice of vehicles and structures in which to invest, potentially there may be fewer UK offerings as managers look to attract European capital and do European deals, in which case they may look to jurisdictions such as Ireland and Luxembourg to locate the funds, but all this remains to be seen. This leads me on to say a few brief words about choice of vehicle and choice of jurisdiction. Essentially, there are a number of fairly common vehicle types, such as partnerships, trusts and companies, and a number of pretty common jurisdictions where these vehicles are established, such as the UK, Ireland, Luxembourg, Channel Islands, Cayman Islands and Delaware. In each case, there will be a few non-tax issues to consider, which I'll come on to in a moment. But to a much larger extent, the choice of vehicle and jurisdiction will be part of the tax structuring exercise undertaken by the fund manager. Simon will be talking shortly about some of the key tax considerations in structuring funds and other investment vehicles. But in terms of non-tax issues, it will obviously be important that an investor invests in a vehicle where the extent of its liability is clearly limited. This is not normally an issue because the types of vehicles that are commonly used for these sorts of structures all have limited liability built into them. In terms of jurisdiction, most managers will tend to stick to the familiar. Establishing a fund in a less well-known jurisdiction may, at the end of the day, be perfectly fine, but is likely to prompt additional due diligence questions from investors and therefore potentially make it more difficult to get to a point where the fund is launched. There can, of course, also be reputational issues with certain jurisdictions. The inclusion of the Cayman Islands on the EU tax haven blacklist earlier this year and its recent removal from that list is a case in point. We have certainly seen investors shy away from Cayman as a direct result of that, even though, in fact, the inclusion of Cayman on the blacklist really didn't actually mean very much. But purely from a reputational perspective, certain investors became unwilling to look at Cayman whilst it was on the list. Before I hand over to Simon, who is going to take us through some of the tax considerations related to structuring funds, I thought it would be helpful to just set out some illustrative examples of the types of fund structure that we see. Some of this is really just so that you're familiar with the terminology, as Simon is going to be touching on some of this later. As you'll see, we've divided the slide into 4 quarters. The top left-hand quarter, which we've described as basic fund, you'll see that that is similar to the pool fund structure that we had earlier. So this is essentially a single fund vehicle into which investors invest. This is the most basic type of structure. Moving down to the bottom left, we've illustrated what we call a feeder fund. So there you'll see that, again, you have a main fund vehicle which some investors will invest directly into, but other investors may not invest directly into that fund, but may come in instead via some other vehicle, which we call a feeder fund. A feeder fund, obviously, because it feeds into the main fund. Then if we go over to the right-hand side, to the top right, which we've called there a master feeder structure. So the point there is very, very similar in a way to the feeder fund structure, but essentially you have a main fund, which is the master fund, and no investors come directly into this. All the investors come into one or more feeder funds, and those feeder funds then invest into the master fund. So that's what's referred to as a master feeder structure. And then on the bottom right-hand side of the picture on the diagram, we have what we call a parallel fund structure. So Here you have fund investors who will come into one of several different fund vehicles that are offered to them. They won't come into more than one, they'll just come into one, and Simon will talk about the reason for this later. With this structure, although investors will come into one of several parallel funds, all of those parallel funds will then effectively invest and divest in parallel. So it is, in a sense, one whole single fund structure, but there are a number of different vehicles which investors may choose to invest in.
Thanks, Tim. Moving on now to a slightly simplified and anonymized version of a fund for which we've helped investors go into. This is a typical structure for going into investments in the US. It looks like a bit of a maze, but all it's really doing is showing that while investors don't have an awful lot of room for maneuver in terms of structuring, this is balanced with the manager's desire to attract as many different types of investor so that he can attract the most money in terms of investment. One size doesn't really fit all, so we have to accommodate the investors. So the left-hand side here shows what US investors might want, but we're really concerned more with the right-hand side, where UK and European pension funds may invest. Picking up on a point that was made earlier, there's a feeder fund here of either a Cayman Limited Partnership or a Luxembourg Limited Partnership, and that's really not so much tax but down to preference to do with the blacklist and reputational issues. If the UK pension fund is happy to go into a commingled Cayman partnership as opposed to a wholly owned subsidiary, and some investors do make that distinction, then typically they would go into the Cayman Limited Partnership as a feeder, and the bottom Cayman partnership would be the master, although there's Delaware and Luxembourg as well, so this is illustrating the parallel nature of it. I've put in there a box marked blocker entity, and that's jargon, but all it really means is that we put a non-transparent for tax purposes vehicle into the structure, such as a Cayman company. And the effect of that is that the income and capital gains from the underlying investments are received by that entity as opposed to the pension fund itself. I'll come on to why that might be important from a trading point of view in another slide. So in terms of tax considerations for investors, one of the big things is that if you're going to go into a fund, you don't want the fund itself to make the tax position worse than if you just invested into the investment directly, such as you would for perhaps a fund of one and certainly an investment management agreement. Essentially, there's three common techniques for achieving tax neutrality. The first is to have only tax transparent vehicles, which would mean that we didn't use any blocker vehicles, just that the fund receives, the pension fund investing receives the income and capital gains from the underlying investments, which can be good in that the pension fund has a good tax regime. On the other hand, if you're looking at possible trading situations, which we'll come on to, then that would not be so good. If that were the case, the second option is to look at using a fund vehicle in a country with a favourable double tax treaty, typically Luxembourg CIFs, or where there's no tax from Luxembourg for capital gains or income, There's a variety of others as well. Gaining importance is the Irish ICAV, which is increasingly used. The last option is to establish a fund in a low or zero tax jurisdiction. Examples here, as we've said, are Cayman for the US, or BVI for US, and typically Channel Islands for Europe. So other major tax considerations would be withholding tax. This is where there's withholding tax on distributions from an investee portfolio company up to the fund vehicle. And it will depend on the jurisdiction of the investment portfolio company. Many European jurisdictions impose withholding tax, say, on dividends. Obviously, the UK doesn't. Now, you can rely on double tax treaties, but that will depend on whether the fund vehicle is transparent and therefore, effectively ignored when seeing if a double tax treaty will apply. You just look at the jurisdiction of the portfolio company and the jurisdiction of the investor. If you've used opaque vehicles such as a blocker in a tax haven like the Caymans, that will impede your ability to use a double tax treaty, because it's just imposed, it gets in the way, and you can't really use the treaty. They don't have them, and it won't apply. The other major thing that's been happening is the BEPS project. This is where the governments have got together and essentially truncated the process by which you can update the double tax treaties. And they've imposed such things as a limitation of benefits rules. So this is where you don't have to renegotiate the entire treaty, but you can effectively amend it in a much shorter period of time. What effect does this have? Well, it's getting at its anti-abuse mechanism, and we're typically seeing quite a lot of structures having to be revisited. We had one recently where a UK pension fund had invested in the US via a Luxembourg series of companies. What happens now is that the jurisdiction of the investment, i.e. the US, can look through and essentially ignore the conduit vehicles unless they meet the limitation of benefits clause. What does this mean? Well, a typical one is the impact of Brexit, where the limitation of benefits clause basically says you look through the Luxembourg entities, and if there is an EU member state entity behind them, then that's fine, and the double tax treaty still applies. However, the UK, of course, left the EU technically on the 31st of January this year, and so the limitation of benefits clauses are no longer met, and the benefit of the double tax treaty has now gone. So typically we're having to look at other structures in order to give the same result, because the previous structures are no longer tax efficient. So in terms of US structures, which we see quite a lot of, there's various US taxes, and we work obviously very closely with our US colleagues. The first major tax involved in pension funds investing is what's called UBTI, but that really only affects US pension funds, so I will leave that out of the discussion. For UK pension funds, what we see a lot of is ECI, which is effectively connected income. That's US jargon. What it means is that if you're in a transparent fund and that fund is doing enough to be considered engaged in a trade or business, which is actually quite wide and catches people out quite a lot of the time, then you can be subject to US federal income tax and even branch profits tax. And moreover, you have to do US tax return filings, which we find particularly unpalatable to UK pension funds. However, it's very typical to use blocker structures, partly because you have UK pension funds not wanting to be seen to trade, even if that's only in the US, and partly because you can isolate the ECI in a blocker, and although the blocker bears the cost of the tax, it does mean that the UK pension fund doesn't have to file any tax returns in the US. Moreover, typically using a blocker entity doesn't actually increase the overall amount of tax, so it can be done very simply by having the blocker entity. The other major tax we always have to have one eye on is the FATCA tax, but often that doesn't result in withholding because it's, as many of you will know, merely a instrument to make sure that the IRS have the information that they want. The final tax consideration for this morning's seminar is to consider whether fund vehicles are fiscally transparent, opaque. If they have any blocker entity in there, then they'll typically be opaque, because to be transparent, what we mean is that there's no opaque vehicles at all between the investor and the underlying investment. Many of our clients want to know that they are not trading, that they are only making investments, and that can be true anyway, just because of the nature of the fund, but it's often sensible to insert a blocker, especially if investing into the US, because as we've said, it doesn't necessarily increase the overall tax in the US, but what it does mean is that the pension fund isn't seen to trade. The major difference if a pension fund trades, of course, is that it loses its tax exemptions. They are exempt from investment income and from capital gains, but trading is when we're doing more frequent investment and disposals. So you need to decide whether it's going to be fiscally transparent and whether it will do enough on its own, or whether you need to insert a blocker. Finally, turning to our own potential investments, investing into property investment LLPs can be problematic, as they will lose the pension fund its benefits. However, the property investment LLP is rarely used in the context of pension funds, as you can always rely on the typical limited partnership. I'm now going to hand you back over to Duncan.
Thanks, Simon. This brings us to the end of this webinar, which forms part of this year's annual pensions conference. Thank you very much for joining. We hope you found it helpful, and please do get in touch if you have any follow-up queries. If you submitted questions during the course of this webinar, we will get back to you shortly. If you'd like to get in touch at a later date, please use our contact details, which are currently displayed on the screen. We look forward to welcoming you again soon.